love the channel and find it useful in becoming a happy retiree. Subscribe today. We are in, what are we talking about today? Tax purgatory. We are stuck in this tax on, tax off, corporate yes, corporate no, cuts or not, who's going to get a tax increase, who's going to get a tax decrease. The numbers look as though less and less people, from what I can tell, are going to get a whole lot of material, anything. And we want to talk about what actually is going to move the meter for you with this new tax cut that we think is coming at some point in the distant, not so distant future. There's going to be a lot of wrangling about taxes, how it's going to impact you in particular. Are you a small business owner? You get a W-2 wage, you 1099. How do you save for retirement? What bracket are you in? Married? Not married? Estate tax? No estate tax? Senate plan? You name it, it's confusing. So we're here to answer those questions and try to walk you through what this might mean, how you can prepare for it on a Sunday morning. So let's start with that. So we finally get this break in the market's run. I mean, the statistics here are pretty remarkable. Just for the week, Dow down about 0.5%, the S&P 500 down about 0.25%, and that ends a very long winning streak, an 8-week winning streak. But this is even more remarkable. So we haven't even had a 0.5% correction in the S&P 500 for one of the longest streaks that we have ever seen. And I go back to Thursday of this week, there was a day that markets sold off pretty significantly. Again, worried about tax reform, tax on, tax off, Senate pushing the tax cuts out for corporations into a 2019. Market didn't like that. Down over 1% on the day, looking like it was going to end the streak. Then all of a sudden, at the end of the day, markets kind of rallied back higher. So S&P 500 only closed down about 0.4%. That is the longest. So that's a 47-day streak without even a 5% correction. That's the longest streak we've seen since 1965. That's 52 years. We haven't seen anything this placid. So things are going to get choppier. And I think Thursday is a preview of markets getting more volatile as we go through this sausage-making process that is so difficult, and that is tax reform. We are in this scenario where everything that trickles out of Washington will start to move markets. So we have tax reform on, tax reform off, corporate cuts. When are they going to happen? If they're going to happen. So not only do markets, not only are they confused if we're going to have tax reform, there's also the question, if we get it, what's it going to look like? And we touched on this last week. I am not seeing, and I keep looking at different scenarios for different families and different income ranges, and I'm not seeing a huge tax benefit for most people. Maybe $500, $400, maybe $1,500, maybe $2,000 from the most of what I'm seeing. And the Tax Foundation or Tax Policy Center, I've seen a ton of reports that are very misleading that says that these super high tax earners or super high income folks are getting this giant tax cut. And I'm just not seeing that. So you've got these, so think about, and we have a lot of folks that listen to Money Matters that are probably in a really high tax bracket. Are people listening that make over $1 million a year? Absolutely. People listening today make a couple $1 million a year? Absolutely. So the super high earners, and from everything I could tell leading up to tax reform, you would see a little bit of a break. But from what I can tell, there might not be a break or a tax break coming at all. So here's an example. So somebody making, let's say, $1 million, they could see, because of where the new brackets are placed, I could see a $25,000 tax cut in that range. And if you're married filing jointly, let's look at the $1.2 million a year up range. Now, don't tune out just because that's just for the super rich. This affects everyone. So the tax cut, the reason you get a little bit of a tax cut on the brackets is that the highest tax bracket doesn't kick in until a lot later. The way taxes are now, you hit if you're married filing jointly around $450,000, you start to hit that highest bracket. Now the new brackets in both the Senate plan and the House plan doesn't kick in until, let's call it $1 million. Couples 1.2. So you get a little bit of a tax cut on where the brackets are, but then you lose the state and local tax deduction. Now, the Senate plan you lose the whole thing. The House plan says you can keep 10 grand worth of deduction. But think about how much that impacts the bottom line. $60,000. So if the same example, making $1 million a year, you're paying and we're in a relatively low tax state here in Georgia. These numbers get exacerbated in high tax states like New York and New Jersey. But in the state of Georgia, you get a $60,000 state tax deduction for that, because that's about what you'd pay in state taxes. You probably get something like a $40,000 local tax deduction. So now you're talking about a $100,000 deduction that is in both plans either going away completely or going away mostly. So what does that loss of the deduction mean? You lose a $100,000 deduction, that would cost you at least $35,000 because again, you're in a higher tax bracket. So you keep 25 more, but you lose 35. So you have a net tax increase. So the new tax plan would save you 25 grand on one end, but it would cost you an extra 35 on the other end. And then that's a net tax increase. Now, where these analyses are coming from, they might be, from what I can tell, assuming that a lot of the really high tax earners are small business owners that might get that 25% tax rate, but the House plan says it's a 70-30 split, so you only get the 25% on 30% of your income. The other 70% goes to your highest ordinary bracket. In the Senate plan, there's a bunch of different exclusions. So if you're in a service business, you're excluded from that, or if you make over $75,000 or $100,000, you're excluded from a small business tax cut. So the Senate plan, from what I can tell, isn't quite as generous for the individual. And remember, if this gets done, and I do think it gets done by the first quarter of next year, not this year, the cuts for individuals, even if we meet somewhere in the middle, probably not a tremendous uptick. So AMT, yes, that part of it could be a big deal. So that's the alternative minimum tax. Both plans want to get rid of that. The Senate and the House, they both want to kill AMT. And if you're listening today, it probably impacts you. So this is about over 5 million Americans pay AMT. You may not know you pay AMT, but if you're in the $120,000 range all the way up to $500,000 in income, households that you could get a little bit of a break if we get rid of AMT. Now, I don't see, though, that having enough impact to really boost the entire economy, because we're still talking maybe a couple $1,000 or maybe a couple $100, maybe a couple thousand. It's really the corporate side of all of these tax talks. That's what really matters to your wallet. That's what matters to you and your 401k. That's what will really impact or be the biggest benefit from the tax cut, is the corporation side. And again, it's not going to impact your wallet specifically or directly. You've got to look at this because we're all saving for retirement. We're all trying to get to early retirement. The opposite of what Susie Orman says. We don't want to work until we die. We want to have it a point where we don't have to work anymore. It's the investment side of this tax cut and this tax bill and reform that really matters to you. That's what I see in this tax reform bill. So what does a corporate tax cut mean for earnings? That's the question mark. I want to look at earnings today. We're going to talk about where earnings are placed today on the S&P 500, what a potential tax cut could do for earnings, and then, of course, what that does to markets. Today, there is this worry that markets are overvalued. Yes, it's not because they continue to go up. It's because they continue to trade at now forward earnings about 18 times profits. That's a little above average. So the market is starting to get a little bit of getting a little expensive. So on average, historically, we want to see that ratio, that multiple at about 16.5. Today, we're around 18. That's a little higher than we'd like to see. So the question is, will an increase in corporate net tax earnings because of a tax cut, how much will that really help earnings as a broad, looking at it broadly, and what will that mean for markets? So here we are today. If you look at what earnings have happened, and this is the conversation of, hey, this market's so high, has it gone up so much? Is it sustainable? Is it not? Most companies, so we've just gotten through, for the most part, earnings season. 91% of companies have reported in this for the third quarter. 74% of those companies have reported a positive surprise, and 2/3 of those companies, and this is, I think, important, they've reported positive sales surprises. So revenue is going up faster. So companies are doing business. It's not just cutting the bottom line and cutting expenses and firing people and reducing costs. This is a revenue story. This is a story of the economy's getting better and stronger. Earnings growth, again, for the quarter, so quarter three, over 6% for the S&P 500. That's a big deal. 7 sectors have reported earnings growth for the quarter. And energy, which has been a lagger for, if you go back a couple of years, energy was the main culprit of the earnings recession we saw in 2014, 2015. Energy has come back with a vengeance. So earnings they've gotten better. Now, valuation is always the question. Forward 12-month PE ratio, again, this is the price tag on the market as we refer to, is around 18. That's a little expensive. Over time, what's normal? Well, about 16.5. So today we're at around 18, not a tremendous amount of overvaluation, but still on the pricey side. Now, if, what do earnings look like tomorrow or over the next year or once we get corporate tax reform? Well, today, if we drop rates, so again, the top rate now in corporations is 35%. A lot of companies have deductions just like people do, and the effective tax rates for corporations are around 27, 28%. If corporate tax rates do get, in fact, dropped to 20%, or let's call it a number in the 23 range, and the effective rate is lower because you'll still get deductions, and we see an effective rate of 20%, you're going to see a 7%, not bad, a 7% rise in overall earnings. If we do, in fact, get a 15% rate, so let's call it a 20% corporate tax rate, so the effective rate drops down to 15, we're going to see a 14% rise in overall earnings. That would put a market that is today trading around 18 times earnings, forward earnings, back to 16.5, and that's where we want it to be. Back to, quote, normal. And there's really no such thing as normal. It's just that we get to a point where the market's not overvalued anymore. It's fairly valued. So that, to me, is really what we have to watch for. There's a reason tax reform has only been done one time in almost a century. It's a messy, enormously difficult process. Every single line, if you think about it every single line in the tax code is there for a reason. Somebody lobbied for it. Some companies, trade groups, like the National Association of Home Builders, who's weighing in on this debate because they don't want Congress to mess with the mortgage deduction. One of the plans messes with the mortgage deduction. So every single deduction that's in there is in there for a reason, and somebody spent millions of dollars to have the tax code positively impact their economic interests. We spent a lot of time last year talking about the lobby index, companies that know how to get things done in Washington. It's no surprise that those companies have earnings that outperform the market. So something like, again, the mortgage deduction is almost seen as a birthright for a lot of Americans. So every tiny change, we're overcoming years of lobbying and millions of dollars spent. And these items like the mortgage deduction are entrenched in the American psyche. So that being said, major legislation almost never just passes with ease. So I would expect something like this to take a long time. And I think you'll see it look like, hey, is this thing on life support or is it not on life support? And you're going to hear the death of tax reform may be greatly exaggerated depending on the current environment, depending on what's happening with Congress, depending on what Donald Trump does. So we're going to see a lot of back and forth, and it's going to take its toll on the market. You're going to see days where we lose 1% like we did last Thursday. We're going to see volatility come back. But ultimately, I think it gets done. So we're in purgatory for now. We're in tax purgatory for now. We're in confusion for now. Markets hate uncertainty. They can't stand confusion. And that's exactly what we're going to be mired in for the foreseeable future. But we also know that markets are not pricing in tax reform. So the stock market, and you can look at this a lot of different ways. You can find and look and track companies that would have the highest benefit from tax reform getting done, and they're not responding. So if the market really thought tax reform was going to get done, you'd see a lift in these corporations. We haven't seen it yet. So that tells me that the price or the benefit of tax reform is not yet baked in and not priced in to where markets are today. So if it does get pushed through, again, not likely till next year, it's going to be good for business and it's going to be very good for investors. And that's what you and I care about. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.